Hey everyone, and welcome to The Explainer. I am absolutely pumped to have you here today. Look, if you're a CA student aiming for that top-tier, all-India rank level of conceptual clarity, well, you are exactly in the right place. Today we're running a high-octane revision marathon for Chapter 5, Acceptance of Deposits by Companies. We're going to totally decode the exact provisions, those sneaky hidden exceptions, and the classic traps that examiners just love to set. So get your mental highlighters ready because we're leaving absolutely no concept untouched.
Here's our master roadmap for today. First, definitions and traps. Second, Section 73 on members. Third, vital deposit rules. Fourth, Section 76 on the public. And finally, defaults and penalties.
All right, let's jump right into Section 1, definitions and hidden traps.
Corporate law is rarely just about what a term actually means. It's usually about what the lawmakers intentionally decided to leave out. Under Section 231, a deposit includes literally any receipt of money by way of a deposit or a loan in any form by a company. It's a massive blanket definition, but here's the secret for your exams. The examiner actually doesn't care about this main definition, not at all. They care entirely about the exceptions prescribed in consultation with the RBI. If an amount falls under an exception, say a standard bank loan from HDFC, then the strict deposit rules just don't apply.
Okay, so how do we memorize these 20 exceptions? Think of them in two buckets. First up, the safe zones. This is money from the government, foreign banks, public financial institutions, commercial papers, and intercorporate loans. These are already highly regulated elsewhere, so they aren't considered deposits. But your focus? It absolutely must be on the second bucket, the business traps, which we've marked with 3 stars. This is exactly where examiners twist the facts in case studies regarding advances, startups, directors, and employees.
Let's zoom in on those top business traps. If a company receives share application money, they have exactly 60 days to allot those shares. If they don't, they have 15 days to refund it. And if they miss that 15-day window, boom, it instantly becomes a deposit. For startups, let's say an angel investor gives 25 lakhs or more in a single tranche via a convertible note repayable within 10 years, that is totally exempt. Now for business advances against goods, there's a strict 365-day maximum limit. And if an employee gives a security deposit, it cannot exceed their annual salary. Missing these little details is a super common mistake, so lock them in right now.
Moving on to Section 2, Section 73, deposits from members.
When a company wants to raise funds but doesn't want to go to the bank, the first place they usually look is their own internal family, their shareholders. So, here's how a company legally takes money from its members. Step 1, pass an ordinary resolution. Step 2, issue a circular in Form DPT-1 detailing the company's financial health, and you got to file it with the ROC 30 days before issuing it. Now, Step 3, and this is heavily tested. By April 30th every single year, you must deposit at least 20% of the deposits maturing in the following year into a separate scheduled bank account. This is called the Deposit Repayment Reserve, or DRR. Why? Well, it's a mandatory liquidity safety net to make sure members actually get paid back. And finally, Step 4, attach a statutory auditor certificate confirming no past repayment defaults exist.
Now, the law does cut a little slack for private companies, making this a medium probability exam target. Certain private companies are actually exempt from issuing that DPT-1 circular, creating the DRR, and getting the auditor certificate. So who gets this pass? First, private companies accepting up to 100% of their paid-up share capital, free reserves, and securities premium. Second, startups, but only for their first 5 years. And third, companies meeting what I call the rule of 3. No associates, borrowings less than twice their capital or 50 crores, and absolutely no subsisting defaults. But hey, keep this in mind. Even these exempt companies still have to file the DPT-3 return with the ROC.
Let's hit Section 3, Vital Deposit Rules and Administration. Here's a golden rule for you. A company can never, ever accept deposits repayable on demand. The standard timeline to remember is 6 to 36 months, minimum 6 months, maximum 36 months. But what if a company, let's say Tata Motors, urgently needs short-term working capital to pay out festive bonuses? Well, there is an exception. A company can accept a deposit for as short as 3 months, provided this short-term deposit doesn't exceed 10% of the paid-up share capital, free reserves, and securities premium.
Okay, let's talk about the absolute limits for accepting deposits from members. We use a base formula across the board here. Paid-up share capital, plus free reserves, plus securities premium. For specified private companies, like say a local tech startup, there's actually no limit. For other standard private companies and IFSC public companies, the ceiling is 100% of that base formula.
And for all other companies, the maximum limit is firmly capped at 35%. Right. Now, here is a massive area where students mess up in practical questions. Premature repayment. If a depositor suddenly needs their money back after 6 months, but before maturity, how on earth do you calculate the interest? Step 1. Round off the holding period. If the extra months are less than 6, ignore them. So 2 years and 3 months just becomes 2 years. But if it's 6 months or more, you round up. So 2 years and 7 months becomes 3 years. Step 2. Deduct a 1% penalty from the interest rate for that period. The only time this penalty is waived is if the repayment is done to comply with statutory limits or for something extreme like a war risk emergency. 18%. Let that sink in for a second. When I say this number, I want you to remember it as the ultimate financial stick. If a company fails to repay a matured deposit or its interest, they are legally slapped with a penal interest rate of 18% per annum for the overdue period. It's huge, and it is exactly why corporate directors lose sleep over defaulting on deposit maturities.
All right, time for a 30-second rapid-fire admin recap to help you secure those easy MCQ marks. Deposits can be held in a maximum of 3 joint names. The company absolutely must issue a deposit receipt within 21 days of receiving the money. A register of deposits has to be meticulously maintained. The annual DPT-3 return, which contains all deposit info up to March 31st, must be filed by June 30th, and any interest or brokerage paid, it cannot exceed the max rate prescribed by the RBI for NBFCs.
Section 4 now. Section 76, Deposits from the Public.
Look, inviting money from the general public is a whole different ballgame compared to taking it from your own members. The compliances are incredibly strict because retail public money is on the line. First off, not just any company can do this. You have to be an eligible company. That means you're a public company with a massive financial footprint, a net worth of at least 100 crores or a turnover of at least 500 crores. To go ahead, you generally need to pass a special resolution. But watch out for this sneaky examiner trick. An ordinary resolution is actually perfectly fine if the deposit amount falls within the borrowing limits that were already approved under Section 180(1)(c). Now, looking at the Section 76 limits, if it's an eligible government company, they can accept up to 35% of their paid-up share capital, free reserves, and securities premium in total. But for a non-government eligible company, you must memorize this exact split for your exams. A maximum of 10% can come from members, and a maximum of 25% can come from the public.
Because we're dealing with retail public money here, the safeguards are intense. The company has to obtain a fresh credit rating every single year. If it's a secured deposit, a charge on assets must be created within 30 days. And, crucially, you cannot use intangible assets like goodwill for this. It has to be a hard asset, like a factory building. On top of that, you must appoint a deposit trustee using Form DPT-2. And trying to remove this trustee? It's nearly impossible. You need the consent of all directors present at a board meeting, and if the company has independent directors, at least one of them must be present to agree.
And finally, Section 5, Defaults, Penalties, and our mega revision.
You've got to look at these Section 76A penalties. Honestly, it's essentially a corporate death sentence for compliance failures, and it's an absolute favorite for examiners. If a company contravenes the rules, they face a minimum fine of 1 crore or twice the deposit amount, whichever is lower, and that can stretch all the way up to a massive 10 crores. But for the officer in default, it gets personal. They face up to 7 years in prison and a fine somewhere between 25 lakhs and 2 crores. If the examiner mentions the intent was fraud, they also get hit with the infamous Section 447.
So throughout this explainer, we've been tossing around the term net worth. Let's completely lock down that calculation under Section 257. You add paid-up share capital, reserves created out of profits, securities premium, and the credit balance of the P&L. Then you subtract the debit balance of the P&L, any accumulated losses, and deferred expenditure. But here is the classic CA final trap, so listen closely. Never, ever include reserves created out of asset revaluations or write-backs of depreciation. Exclude them entirely. Before we completely wrap up, I want to give you a quick memory trick for the DPT forms so you can recall them instantly right before you walk into the exam hall. Ready? DPT-1 is your invitation or circular. It's the very first thing you do. DPT-2, well, it takes 2 to trust, right? So that's the deposit trust deed for your trustee. DPT-3 is the 3rd month from the financial year end, which is your annual return due June 30th. And DPT-4 is for forepast, meaning transitional provisions for past deposits accepted before the 2013 Act.
So I want to leave you with this provocative thought to chew on.
If a company defaults on a 50 crore public deposit today, are those directors truly ready to spend 7 years in a prison cell? The real-world consequences of these deposit laws are incredibly severe, and that's exactly why they demand your absolute precision. Do yourself a favor, review Section 76A one more time tonight, trust your preparation, and go out there and crush that exam. Thanks so much for joining this explainer and keep learning.